Brett is looking next. What are you looking at next, Brett?
We
It's
are
a
looking
gold
at,
company. Is it Equinox?
I was going with Equinox, but
Equinox. Either
I,
way,
one of
it's
the
tomato,
two.
tomato.
Someone's going to complain in the comment that I'm saying the company wrong, and I know
Oh,
nothing.
or me. One of us.
Or,
We've
yeah,
got it
one of us
covered.
is
The complaints are covered. Don't worry.
Yeah, you can complain about one of us. All right, though. I'll get into it.
You got some slides?
Yeah, I got slides.
I think somebody said that about Zbeck for us, where we weren't pronouncing the name Zbeck right, and then they ended up going bankrupt. Anyways.
Every company that we
don't
mispronounce
understand.
goes bankrupt. That's the trend.
Yeah.
All right, though.
Sorry, just Equinox Gold. Here we go.
Formed in 2017, as me and Ryan are still confused about the name, Equinox or Equinox Gold Corp, symbol
Equinox,
EQX.
probably.
Equinox. Who knows? But it is symbol EQX on the TSX as well as the New York Exchange. It's a growth-focused gold producer with 7 operating mines and a clear plan to increase production by advancing a pipeline of growth projects. The company has operating and development projects in the US, Mexico, Brazil, with a development project in Canada, and is expecting to produce 590,000 ounces of gold in 2023. The stock is up 21% year to date, trading at $5.93 a share with a market cap of 1.86 billion Canadian, but that is down roughly 65% since its 2020 high of when it just tapped $17. So for the last quarter for Q2 2023, Equinox produced 138,000 ounces of gold, sold at 1,962 per ounce compared to 121,000 and 1856 in Q2 2022, resulting in revenue of 271.6 million compared to 224.6 million in the previous year. Adjusted EBITDA increased to 70.9 million from 24 million. Adjusted loss per share was still 2 cents versus a loss of 16 cents in the prior year, with the core adjustments for EPS being related to hedging derivatives. It's not one of those ones where it's unreasonable to use. But looking at the balance sheet, Equinox holds cash of 174 million with loans and borrowings of 835 million, resulting in a net debt position of 661 million at the end of the quarter. The resulting leverage is a net debt to adjusted EBITDA of about 2.9 times, which is high leverage for a gold miner. As well, after the quarter ended, the company issued 172.5 million of convertible debt to switch its floating rate credit line into longer-term debt at a lower interest rate, at least for the time being. Of course, if floating rates drop, then their long-term could end up being more in the long term, as well as they're preparing their cash as they have previously issued debt maturing on April 2024. Of course, being convertible debt, it could potentially dilute the stock in the future if it ends up trading above US $6.30. But that is a fair way to go at this time. The 2023 guidance expects production from its 7 mines of 555,000 to 625,000 ounces of gold at cash cost of $13.55 to $14.60 per ounce, and all-in sustaining costs, or AISC, of $15.75 to $16.95. For the first half of the year, Equinox was on the low end for both the cash cost and sustaining costs, but compared to other producers, Equinox's gold production costs are high, meaning in the case of if gold pulls back materially for a sustained period of time, Equinox would likely be one of the first producers to needing to cut production. The company does have some protection, as it has hedged roughly 25% of its production into 2024, with downside protection at $19.12 per ounce, which is roughly where gold is trading at this time. The company does have a notable growth project, Equinox's Greenstone mine, which is on schedule and is expected to finish construction in early 2024 with its first pour in the first half. The mine is expected to be able to produce 400,000 ounces of gold a year, which Equinox gets 60% or 240,000 ounces. The mine is estimated to have an AISC of 850 per ounce over the lifetime of the mine, which is significantly lower than its other operations, to say the least. Equinox did have a remaining spend of about 170 million to meet that construction demand, though. So Our take, that is obviously a concern. When you couple a volatile commodity like gold with leverage, a lower commodity price can obliterate a company, and any production growth becomes meaningless fast, as these companies, they end up just diluting their shares, which Equinox does have an outstanding shelf issuance at this time, which they've used 25 out of that 100 million. So if they do need to raise capital through shareholders, they are willing to. Also, the mines with high production costs, as mines like Castle Mountain, have the risk of production cuts, which compound the difficulty of paying interest in a reduced gold price environment. And you might be saying, well, gold's just going to keep going up. It's going to stay the same. We just saw late last year in Q3 and Q4, it was between 1,600 and 1,700, which is below Equinox's sustaining gold cash costs amount for some of its operations. So you can see reasonably in recent history that gold prices can pose a risk to this company quite easily. So really, investors need to remember gold miners are already really operationally leveraged. Then if you're adding significant financial leverage like we are here, it compounds risk. Yes, the growth from Greenstone will lower costs, and it's good, but the benefits from the mine won't be realized until late 2024, if not 2025, as production does need to ramp still. As well, Greenstone will have lower average costs, and it may lower than its higher cost, but its average cost for its mining will still remain high, about $1,400 per ounce, which is still not on the cheap end. That's slightly higher than like a major player like Barrick, and they're in their mid 1300s. So overall, really how we see it is the risk just outweighs the reward, especially when you're looking at these commodity producers. High leverage is just a really dangerous thing to play with. So if in 2025 Greenstone is able to be fully operational, producing cash flows, they are able to lower their leverage, it may be worth another look, but at this time, it's just not appealing enough.
Yeah, it's an interesting look at the company. I won't even say their name because we'll get it wrong either way. And noting the high costs right now from the existing operations, the new project they're bringing online at that substantially lower cost looks like it's being priced off of that. Because I mean that does add some level of interest to the company for sure. But the debt levels are high. I mean, for us, we see better ways of playing. If you want to invest in gold, there's a couple drillers out there that offer good valuations, and there's another company we follow that's kind of ancillary to the segment that operates directly in it, but is cash rich, has no leverage, has growth path ahead of it, trades at far lower valuations, and has more certain EPS. So those are the things that we look for. If you want to invest in gold, we certainly have a couple companies that we can gain exposure to that with less risk and likely, more upside over the long term. And we're trying to have less downside as well. So that's what we'd like to do to play the sector. And the companies that we're looking at are not going to fall off a cliff if the price of gold goes down to 1,500. I mean, nobody does great in the sector if it does, but you have some companies that, their cash flows are absolutely crushed. They start losing money. And if they're high debt, you can get into real issues with businesses like that. And that's what we're trying to prevent.
Yeah, I mean, we generally, if you're looking at a cyclical company, we would generally be targeting, debt to EBITDA, ideally under 1 times, but certainly under 1.5. So with this one approaching 3 times, I mean, that's a leverage ratio that we would consider to be above our comfort range for a cyclical company.
Mm-hmm. And I was going to say, even for the one actual gold producer, which we did recommend and ended up getting clients to take profit on for, I believe, about a 50% return, including dividends, they have a cash-rich balance sheet, which is what we liked. They paid a nice yield. So, even if there is all of a sudden a downturn in the price of gold, the company still has cash to keep the lights on, just in case. And they're not having to pay, elevated interest. So, yeah, just thought I'd throw that in there too.
Yeah, no, it's a good point because times when any commodity is high, things look great, but then you've got to be able to sustain when commodities don't do this. They do this, and like every commodity does that. And when there is a period when it's coming down, they have to be able to continue to operate without or they're going to the market at low prices to issue equity, diluting the hell out of your existing position. It's not a good scenario over the long term. So in those higher risk commodity related businesses, pay attention to the balance sheet. And we talked earlier in the show about other businesses. You're paying attention to the balance sheet when interest rates are rising, but you can't predict when they're going to rise or come down. But if you pay attention to the balance sheet at all times in all environments and make sure it's healthy, then your portfolio is in a better position if you make sure the companies, you're invested in companies that have that type of profile.